Good morning, everybody. I am Marina Parkin of Koontz and Parkin CPAs. Today is Tuesday, October 26th. We're inching away at 2021 here. I am joined today by my wonderful business coach, John Seiffer. We are continuing our series of the F word for the small business owners of the financial statements and how everybody hates them, yet everybody needs them, yet some people find them useful and some people don't. So we decided to bring you the series a few months ago just to kind of get our small business owners a little bit more comfortable with the financial statements, and also to stress the need to have the financial statements ready. The most important thing in the last several webinars that we've covered is really how to make them useful for you as the business. It's really important to me because as a CPA, usually I see my clients once a year, maybe 2-3 times a year for tax planning. And I am really looking at it from deductible versus non-deductible, what else can we do standpoint. But my business owners need to be using their financial statements through the year to really understand their business, their numbers, and to be able to make business decisions until they see me for tax, or if they don't see me for tax at all. So John and I had decided to bring the series to you guys to discuss several aspects of using the financial statements. So today we're bringing you 7 critical numbers, and John is going to take over and really discuss with you what those numbers are and how you would find them useful. Thank you, John.
So this is going to be a little bit different than we have in the past. In the past, we've started with some of the traditional financial statements and deviated from there. This time I'm kind of going to go backwards, but I'm going to talk about 7 numbers that I think every business owner should be able to figure out. And the data comes from the financial statements. And then in between each one, I'll let Marina give her take on it as a CPA. So the numbers that we're going to be looking at, these are the numbers that we're going to be looking at, and I'll just show you how they go. So we'll start with gross margin. And if you remember, the purpose of a business is to create a customer, and a customer is somebody that pays you, and they pay you for something that they value more than they value the money. So the gross margin is what it costs you to provide that value for them, and it's expressed as a percentage of the sales price. So it's a percentage. And here's how you compute it. You can take your what's left of your P&L after COGS and do it as a percent of revenue. And many times, I know QuickBooks can do this. Your accounting software can be set up to generate your reports with a percent of revenue as a separate column. And that makes it easier for you. But let's go back to the P&L, or the income statement that Marina did for the favorite pet veterinary clinic, if you remember this. And this was not the one that came right out of QuickBooks, but then she modified it by putting in some of the other costs in some of these different categories. And we're just going to look at this part here. So I've expanded this, and this has your income and then your total cost of goods. So we're going to zoom in to that. And when you subtract the cost of goods from the revenue, you get gross profit. That's a dollar amount. Then we're going to take that dollar amount and divide it by the total income, which in this case is $1,350,000, and we get about a 50% gross margin. So that's what is left after spending the dollar that the customer pays for actual service or product that they're buying. 50% of that is left. And the reason that this is a useful number is it will help you determine if you need to change your prices or if you need to get more sales. So if that percentage is not high enough, then maybe you should raise your prices, or you should try to figure out how to make your COGS be lower. But if that percentage is a decent amount for your industry, but you're still not making the profit that you want, then you need to just do more of it and make more sales so that that profit will cover your fixed expenses. And understanding how this gross margin works will help you with that. It will also help you to compare your company to others. This is for a private company, this is most useful to comparing within your industry. For public companies, you can do it across the board. But if you look at industry numbers for your industry and you find that the percentage of gross margin is higher or lower, you can tell how you're doing. So, and it does vary by industry. So in the restaurant business, gross margin is, I think cost of goods is like 30%. In the software, gross margin can be up as 90%. In other businesses, it's much lower. So it really depends industry to industry. And the third reason to use the gross margin is to project growth and hiring. So let's say you wanted to hire an administrative person to help with the office staff, and you say, well, their salary is going to be $50,000 a year. You want to know how much more sales, how much more revenue do you have to generate to cover the cost of that person? And if you know the gross margin, you can say, oh, it's half in this case. So if I need to hire a $50,000 a year person, then I need $100,000 in revenue to cover that nut. So those are some of the ways that you can use the gross margin. So Marina, I'll throw it back to you. Any thoughts you have on this?
My only thoughts here, John, is of course that number is going to depend on what you have in your cost of sales expenses, right? So if how you've classified it in your system is you only included salaries, or you only included half of the salaries or all of the salaries, or you may have accidentally included rent. So you really need to dig a little bit to see how you have your let's say QuickBooks file or other bookkeeping software set up as to what numbers it's pulling to be classified as cost of sales, to make sure that that gross margin is accurate, or it makes sense to you and is useful.
Yeah, and one of the things that I find with my clients is that often the way it comes out of the box, these reports all put labor or payroll in a separate category, and they don't take into account the labor that is actually cost of goods. And often that's because it makes it cheaper or simpler to just run your payroll that way. And the other reason that it's done is that some people have, they split their time. So yes, they are doing cost of sales, cost of goods in part of their time, but they're also doing administrative overhead kind of stuff. And that's why you might want to just make some rules about how you take your income statement and export it into a spreadsheet, and then how you tweak it a little bit in the spreadsheet. So the next one that we're going to get into is the customer acquisition cost. It's also called CAC in startup world now. And this is, what does it cost you to get a new customer or a new sale? In different industries, it's done a different way. If you have a lot of repeat business, then you're really looking to get new customers. If you have one-offs, like in a lot of retail where you really don't know who's coming in and buying, then you may be computing it as per sale rather than per customer. But it's the cost of getting that new one, that next one, and it's shown as dollars per customer or sale. And the way you compute it is you add up all your sales and marketing costs, which would include the labor, and you divide by the number of customers or sales that you got. So to take this back to our favorite pet vet, we're going to take the marketing and sales and advertising and all those costs, and we from the income statement, we found out that that was $82,000 for the year. So if this business owner had gotten 1,000 new customers, then the cost would be, you just divide that 82,000 by 1,000 and you would get $82 is what it cost them. Now, 1,000 new customers for a vet clinic sounds like a lot. So maybe it was 100, and now their cost is $820 per new customer. And that's how you figure out what does it actually cost you. And the reason that you would do this is to see if your sales process is efficient. How much is it really costing you to get a new customer? And the other reason is that you can use it to test new marketing and sales ideas. So let's say you've been marketing on Facebook for a while, and then you say, well, I want to try marketing on Google Ads. So I'm going to switch my budget over. And then you can do this for 6 months and see, does it cost you more or less or the same to get new customers through Google Ads as opposed to Facebook or the other way? And that's the main reason that you want to know this. We'll get to another one in the next piece. But anything that you want to share on this, Marina?
John, I don't remember who you quoted when you told us a while ago that only half of the advertising dollars work. The problem is you don't know which half.
Right. That's a very famous quote from, I forget who it is.
I tell all my clients this when we talk about anytime I see the advertising expenses on the P&L, and I said, do you know if this is working for you? Because only half of it does, but you don't know which half. So I would say we put all of it into the customer acquisition cost and hope for the best.
Right. Well, the hope for the best means you really want to track the number of new customers that you get and see if it makes sense. I think a lot of people make the mistake of thinking, well, we're just paying to get our name out there, and that will help. I'm not sure that helps. What's the point of getting your name out there? You're not running for public office. You're not trying to be famous. You're trying to run a business. And so the only purpose to get your name out there is if that brings in customers. So that's why this is important. So, but this number plays into the next one, which is the key number called lifetime value of the customer. This is what a customer is worth to you. So if it costs you more to get them than they're worth, that's a problem. And it's shown as $1 per customer. So this is in dollar figures, what that new customer is worth. The way you figure it out is you take your gross margin and you multiply it by your average sale. And then you multiply that by the repeat sales over the lifetime of how long they are a customer of yours. And that's your lifetime value, because the dollar that they spend with you, in this case, half of it just goes to providing that service. But the other half times their average sale and times the number of sales that they make is the lifetime value. So I just plugged in the numbers from the vet business. Their gross margin was 50%. I made up that their average sale is about $300. And let's say somebody comes in 3 times a year with their dog or cat or bird or elephant or whatever it is. And but they stay for 10 years. So they're a customer for 10 years, because typically once people find a vet that they like, they stick with them for a while. So that would mean that over the course of that lifetime, they would be there 30 times. 30 times $300 per time times 50% means that that customer is worth $4,500. Now, if you think about from the last number, CAC, if it costs $820 to get that new customer, but over their lifetime, they're going to provide $4,500, that's a worthwhile investment. Now, you have to make sure that the timing works out, because this is over 10 years of that customer's life. So you want to make sure that you have enough money, you have the cash flow when you pay the advertising and the marketing expenses, because they're not going to give you $4,500 in the first year. But once you have that person, then this is why they're valuable. This is before I go to the next slide, I just want to tell you a story. One of the companies that I had, it took me a long time to figure this out. And once I did, I realized how valuable my customers were. And I realized that I had been cheaping out on the marketing because I always looked at marketing as, an expense rather than an investment. And as soon as I saw how valuable my customers were, I ramped up my marketing so I could get more of them, because it really was worth it. So here's why you do this and how you can use this is, first of all, are you spending enough on marketing and sales, which is the lesson that I learned I wasn't. Can you increase your gross margin? Can you improve that? Because these are all multiples that go into the lifetime value. Can you increase your average sale? That's why, you know, the joke with McDonald's is, do you want fries with that? Well, because they've already paid to get you in the door. If they can give you fries or give you a milkshake or give you something else, then it increases that average sale. And then the repeat, if you can increase the number of repeat sales. This is why grocery stores and other companies now do loyalty cards. You know, you go to the coffee shop and they have a little card and they'll give you, you know, every time you punch it, you get 10 of them, you get a free cup of coffee. So they're trying to increase that repeat sales without spending any more CAC, any more customer acquisition costs to get you in. So this is how you use that lifetime value.
John, let's talk a little bit about that repeat sales number. I guess this would be very different for each type of business. Are we looking at this as kind of a repeat sales in a certain period of time over certain number of years, or in like one reporting period, or how do you feel?
Lifetime value is the lifetime of that customer's relationship with you. Mm-hmm. So it's how long they stay with you. Now, there's some businesses where it's generally only a one-time sale. Mm-hmm. You know, bankruptcy attorneys. How often do you go into bankruptcy?
Yes.
You know, and to some degree, even something like a realtor or a car salesperson, if they have a relationship with you, you might come back again and again. And you know, you're not going to buy a new house every year, but you might every 5 years as you scale up or scale down or whatever. So it's really the lifetime value of that customer, which is why when you compute this, you also have to keep cash flow in mind. When are you going to get that?
Well, yes, and you have to be pretty in tune then with your stats in terms of, you know, okay, how often do these people come? There's, you know, statistics for every industry, I'm sure, statistics for every kind of industry and size of the business, just like you said with a car. You know, the dealership would have an idea of how often does this person return on average. You know, okay, they're going to buy a new car every 5 years. And so that means that maybe the number of repeat sales from this customer is going to be, you know, 5 or whatever, right? And so versus, you know, for our business, it's a little more predictable. On average, I can say my tax client will be here every year, once a year. So I think that's kind of knowing the industry, keeping a good, you know, record or tabs on how often your clients come back, if you're not kind of an annual repeat business, is going to be important.
Yeah, and it's important to not just know it for your industry, but to know it for your business. Mm-hmm. Are you better than average? So, you know, in your case, Marina, yes, your clients will come back every year, but how long? How many years do they stay? And some of that is under your control. It's under your control about the kind of service and the kind of relationship that you give them. And as their company grows, can you do more for them because they'll need more? But some of it is not under your control. They may move, people, you know, pass away, all kinds of things. So, but whatever business you are in, it's important to keep track of these numbers. How long do people stay with you? How often do they come back? And if you really just do it by gut feel, you're not going to get the right answer. You really should track this in as much detail as you possibly can. And, you know, in some businesses, like retail, for example, you find that there's a handful that come back a lot, and some people never come back. So you really want to invest in those people that do come back a lot, and what can you do for them and things like that. But if you don't keep those numbers, and those numbers don't come from your QuickBooks, you have to track them somewhere else, you'll never know this. And so that's why these other numbers are important as well.
Mm-hmm. What I did, John, for us is I kind of, whenever we get a new tax client, I have a little place where I know what year they came in. So that anytime I can pull a list of my tax clients and say, how many are them from, you know, before our first year when we opened, and then the next year. And so, of course, as clients move away or leave or whatever the case is, you know, those stats kind of go away a little bit, but it's interesting because I like to be able to pull my list at any given point and say, well, how many clients out of all the clients that I have, how many of them came when?
Right. Yeah. Well, this is where I got this for my business that I mentioned. We had a business where we sold movie libraries to apartments. It was a monthly feature, and we changed them out. And I started tracking how long people stayed with me. It was it wasn't software, but it was a subscription kind of business. And once I figured out how long they really did stay, it shocked me how valuable they were. And so I realized, oh man, it's worth putting a lot more money into acquiring those customers. So the next one is cash on hand. How much money do you have? Or sometimes it's computed in how many days do you have till you run out of cash. This is often done for either startup companies that don't have a lot of revenue, or for growing companies where you do have a lot of revenue, but you're growing so fast that it's eating up your cash to do it by number of days. I had a friend who was in the mergers and acquisitions business, and he was helping printing companies basically sell and buy each other. And he said to me, he said, the sign of a growing business is you don't have any cash. He said, that's also the sign of a dying business. So that's not enough numbers to help.
All right. That's great. I love it.
But you want to be able to compute this. And so this, I think we've used this slide before. Sales is vanity, profit is sanity, cash is king. No matter how profitable you are, no matter how high your sales revenue is, if you run out of cash, it's over. And it's not like a video game where you go, oh, game's over, let's play again, and I'll get some new lives and some new, guns or whatever. When you run out of cash in a business, it's over. So this is how you compute it. Obviously, you check your bank balances for the dollars that you have. And then if you have a net cash flow that's negative, because either you're growing or you're starting up or you're investing in, say, a new market or something like that, you compute on an average basis where that is going day by day. And then you can do the division and say, oh, we're losing this much a day. And in startup world, they call it the burn rate. And then you can figure out how many days we have until the burn rate burns up all the cash. And the reason to do this is you start to forecast cash problems in time to do something about it. You don't just wake up on a Tuesday and go, oh my God, we're not going to make payroll this week. If you're not going to make payroll this week, you should have known that coming, before, when there was time to do something about it. And the other reason to do it is to figure out why cash is short. Where is it going? Are you short of cash for a good reason or a bad reason? And if it's a good reason, if you are growing and you need that extra working capital, then if you can forecast it in time, that's the perfect reason to go for a line of credit or to get a bank loan or to do other ways that aren't going to put you into a crisis. So,
John, I can talk about this all day.
I'm sure you can.
sometimes with a martini in my hand. This is, I tell you, when it comes to my clients, I most often get this question, where is my cash? When I hand them a tax bill. So we're doing a tax return. Say they're an extension. We're doing their tax return 9 months after the year has already gone. So when I tell them, you owe 50 grand in tax, and they say, but I don't have any cash. Okay, I get that, but obviously you made enough income last year to warrant this tax bill. And what happened to the cash that you did make last year? Oh, because now it's 9 months into the next year, you've already spent it doing something else. So when it comes to taxes, then definitely you want to, it's very, very just kind of a difficult relationship to understand, because the business owner is just running at all cylinders and oh yeah, great, I got 100,000 at the end of the year. Well, okay, get it, but let's set some aside for tax. If you're not, sending your estimated vouchers like I told you, and you're just trying to do your own estimated calculation, then please set some aside. Use whatever reasonable rate. If you can't get a hold of me, just whatever, use 30%, do something. Something is better than nothing. But we don't want to get into this conversation 9 months later that I don't think I made all that income because I don't have any cash left. So the timing of the cash, the relationship of it, it's just, it's so fluid, it comes and goes. And when you really need it, you're absolutely right, John. It's growing business, you're completely out of cash.
And for a long time, I didn't understand, not coming from an accounting background, I didn't understand the phrase working capital and why that grows up. But the real reason is, if you think about how cash goes in a business, you sell something and somebody pays you, but you have to invest in building that thing or advertising to get that customer before they pay you. So even if the transaction, when it's all said and done, is profitable, you had to put out cash ahead of time before you got it paid back. So if your business ramps up and you do 10 times as much of that, you're going to have to outlay 10 times as much cash ahead of time before you get the profit, which hopefully will be 10 times as much at the other end. But that's the working capital, is that lag piece. And it sounds like, Marina, those clients that you're talking about, they're not taking advantage of your bookkeeping services where they reports on a monthly basis and have some idea of where that cash is going and know that they could put it aside, on an ongoing basis, rather than just wait till 9 months later and go, oops, what happened?
Yeah,
So,
absolutely.
So the next one is the break-even number, which is how much do you have to sell this month to break even? So break even means you have covered all your costs for the month. And the way you compute that is you take your fixed costs and you divide it by your gross margin. Excuse me, and that's your break-even number. So let's go back to the veterinary service. The fixed costs are all these costs at the bottom here. And if we blow that up a little bit, we'll see that the total expenses for this business are $463,300. And then I add the interest payment, even though it's not technically, it might not be something in, and I would actually add, besides just the interest, I would actually add the principal loan payments, because those are cash that you have to put out. So then this was an annual report. So we take these numbers and we divide by 12 to get the monthly. Then we add them together and we find our monthly fixed costs is $41,942. So that's our monthly fixed cost. The question is, how much in sales do we have to make to cover that nut? And since our gross margin was 50%, it's twice that. If your gross margin was a different number, you would divide and get a different number here. But this business needs to do $84,000 in sales per month to break even. So what do you do with this information once you have it? Well, you can plan, you can correct it, or you can celebrate. So if it's the 28th of the month and you haven't hit that $84,000 number yet, you might be in trouble. If it's the 10th of the month and you have hit that number, then you know it's going well. And so if you have that number in mind, then you can just look at what's your revenue month to date. And then you can say, okay, we're on track, we're a little behind, we can do something about it. You find out early enough in the month to do something. When you do this, what I put back here is I just took the annual divided by 12, but every month is not the same. Some months, for example, have 3 payrolls and some months only have 2. So you want to make sure that you're doing the calculation for the current month when you do this. So any other thoughts you have about the break-even number?
Yes, I have quite a few clients that always kind of talk about it. And I think here, again, we're looking at expenses we're picking up as our fixed expenses, John. So, when we're looking at classification of what is really correlated to sales, and as a result is a cost of sales number or customer acquisition number, or what is really, really fixed that you have to pay no matter what. And, it just, again, depends if you want kind of a quick and dirty number, if you want more detail. Particularly, we talk about splitting the salaries, which salaries do you have to pay no matter what. Your office administration, salary, maybe you absolutely as the owner need to take a fixed salary versus your salespeople salary that are going to be correlated to sales or commissions, things like that. So you really need to spend a little bit of time figuring out what those fixed costs are, and you're absolutely right about averaging them too. I think this is also a little bit difficult for a cyclical business, John. I have one client who's a restaurant client who is trying to kind of figure out, how to price their menu. And it's a little tough because your fixed costs are probably going to be more or less the same even in cyclical times. But if, let's say, you're selling in terms of revenue more during, let's say, the season or summer or whatever it is, then you've set your menu prices to be such that, yes, it seems like, oh, I'm killing it, and in Florida season, but then comes the summer, you still have those fixed expenses. And unless you've set your prices high enough to create some of that cash flow to pay for those fixed expenses during slow time, just doing that analysis flat as an average monthly is only, I think, a starting point, not your kind of be all and end all.
Yeah. And one of the things that the mistakes people make is when they're looking at a monthly average and they get close to hitting it, they feel good. And they go, and if they fall short, they go, well, we didn't make it this month, but we will. What that means is that you have to beat it in some other months. You can't just stop at the average. So if you have some dips, you have to have some peaks as well that go above that average. And if you don't see the bigger picture, that it can get you in trouble. So just to review, these are the 5 that we've looked at so far: gross margin, cost of customer acquisition, lifetime value of that customer, cash on hand, and your break-even number. But wait, there's more. Number 6 is what I call the magic number, and this has almost nothing to do with your financial reports. For most businesses, there is a single number that can tell you how you're doing. It's quick and dirty, it's not exact, but it's something that relates to your business that you can track on a regular basis. So if you have a hotel, then the number is occupancy. It's what percentage of your rooms are you renting out on any given night? Because once that day is over, you can't go back and sell those rooms again. They're gone. So hotels, apartments use this number as well. What's the percentage of occupancy to get that up? But it changes. It's different number for each kind of business. There was a restaurant that I know about where their magic number was how many people were waiting in line to get a table at 8:30 at night. And the reason that they used this number was if there was a lot of people waiting for tables, they encouraged the wait staff to turn the tables over quickly so they could get a whole nother seating in. If there wasn't anybody in line, then they encouraged the wait staff to sell more desserts, to sell more after dinner drinks, to get people to stay, spend a little bit more money so that they could increase the revenue per table, because they weren't going to sell any more tables. So they always looked, what was the line at that time of night? Again, this is going to be different for your business, but you should get a sense for what number really makes things work. I'm reminded of a machine shop that sold a lot of different kinds of things that they made. Some were very small and intricate, some were very big, and the price was different, the cost of each one was different, and they couldn't figure out a general trend until somebody came up with the idea of the weight of the stuff on our shipping dock waiting to go out on a daily basis was an indication of how they were doing, because the big pieces cost more, weighed more, the little pieces didn't. But they somehow figured out that if they just weighed everything, and they knew from the shipping documents, here's the poundage that's supposed to go out today, that would give them a sense of how well they were doing. It wasn't exact, it's down and dirty, but it kind of gives you that sense. So that's something that you can think about for your business. Any insight on this, Marina? I know it's not really a CPA kind of
Oh
thing.
yeah, this is good. I think for us as business owners, we're always also kind of looking at that whether it's number or kind of a feeling. I go back to the story you told us, John, about your client who said, I know how busy I am by the hum of the machines in my in my manufacturing plant. That I think about that often, and I think about that story because sometimes when I walk in my office and my staff is there and people are talking and yelling at each other through walls to ask questions, and it's like, okay, we're busy, we're doing this is happening, like how many, or is it really bad where it's hair on fire and everybody's running around and want to kill everybody, or is it kind of slow where people are just like, okay, we're looking for work to do? It's that hum of the machines that you really do need, like you say, you need some sort of quantitative idea of it. So whether it's how many returns, let's say for us, we have in queue to be done in the next couple of weeks, or how many projects are in pending, or how many calls or how many consults are in. It's something like that where it's a quick and dirty. It's not necessarily like, okay, well, if we have 20 returns for this week, it's great, or if we have 5, that's also great. It's more like, okay, I see that how the flow is going, and then I see that this is doable, it's busy, it's good. It's definitely that intuition plus math.
Right,
that's why it's called magic, right?
Right, that's the magic number. For a lot of manufacturing type businesses, it's the backlog.
Mm-hmm.
How much work do you have in the queue? For service businesses, it might be how far out are you scheduled?
Mm-hmm.
Are you scheduled a week out or a month out? Might be the difference of how you're doing.
Mm-hmm.
But yeah, it's an interesting one, but you should really think about it, because if you just have it in your head and your gut as a business owner, you might be right, but you're not empowering anybody else to get on board with it. Once you have figured out how to compute it, then you can get other people to see it as well.
Mm-hmm.
And the final one is free cash flow. So I'll bring these guys back again, but this time we're not talking about making it through the end of the month. Can I pay payroll? We're really talking about cash flow out of the business as a whole. And we've looked at this before. The reasons to spend money in a company is you spend money on cost of goods sold to provide value. You spend money on CAC to get more customers. You spend money on operations to keep the lights on, to support the making and the selling. And then payback is really money that you paid for growth. So you got a loan to invest in something. And what comes out the bottom is profit. But profit can go in 2 different directions. It can either go out to the owners, or you have to put money back into the business to grow the business. What that means is you're investing in more capacity to make something that customers value and want to buy, or to find those customers. The free cash flow of your business is this piece right here. It's how much can you take out of the business for yourself. And the way you compute it, again, this is maybe not an exact science because there's a judgment piece in here, but you take your net profit and you subtract the cash that had to go into the balance sheet, so to pay back loans and things like that. And then you subtract the cost to grow. So that's the judgment. How much do you really need to spend to grow your company? And what's left is the free cash. It's the cash that you can take out of the company. The company will be fine. It will continue to grow whatever you've decided to grow it at. And so that's the free cash that comes out of the company. A lot of times it's sort of hidden in some of the numbers, because there are things that you can legally do as a tax write-off that aren't necessarily part of the business. And that's, in a sense, that's free cash as well. So let's say you have a closely held company, and it's you and your spouse are on the board, and you decide you're going to take your board meeting and you're going to do it for a week in Las Vegas. And as long as there's a business reason for that and it's justified, you can write that off. And if you, let's say you need to take a flight somewhere, well, you can fly economy, you can fly first class, you can rent a private jet. And as long as there's a business reason for that and the cost is reasonable for the industry, obviously you can't, if a private jet's going to cost you $10,000 and your brother-in-law owns a private jet, you can't pay him $100,000 for that same flight. But a lot of those decisions aren't exactly business decisions. I know very few companies that did better because the owner bought a Lexus, even though they're legally allowed to write it off. So if you add all those things in, you'll find out what your free cash flow is, which is what you're taking out of the business. Now, why would you do this? Why do you need to know this? Well, it improves the valuation of your company. Your company is worth more if there's more cash coming out of it, and it helps you decide on growth. It helps you decide, okay, so I have this cash. Do I want to grow the business or do I want to put it somewhere else? And if it's more money than you actually need to live on, then you can say, well, would I get a better return on this money by investing in my business or investing somewhere else? Should I diversify into, say, real estate or the stock market or whatever? And knowing what your free cash flow is, that can help you decide on that.
John, this is great. We also call this sometimes, especially when it comes to getting the business ready for sale, is owner benefit. So that's exactly what it is. It's being able to say that what are some of the things that are maybe written on there as expenses that are really more for owner's benefit. And I'm glad you put down the valuation, because that is something that when we help companies that are getting ready for sale or we have, let's say, an interested buyer who's hiring us to do some due diligence work on financials, when we look at the financials and we look at the income statement and the balance sheet and the cash flow, we do look at and say, I know to you as the buyer, this may look like the profit is really low or the cash is really low, but let's look at some of the expenses and figure out how much of those were really owner benefit. Pull those out and say, okay, if you don't do anything, this business is generating this much cash. And then, of course, now you can take that cash and pay for some of your stuff, some of which may be a legitimate business expense. Like you say, it's, travel, it's your car, it's the phone, it's the home office. All of those are totally legit write-offs and legit expenses. But it's really, when you're trying to evaluate the cash flow of the business, it's really the things that are coming out to you, which then you can do with as you will, some of which is going to be paying for those things. So it's that owner benefit, it's that take home. It also reminds me, John, of constant requests I get from banks. So if I have a client who's a business owner and they're applying for the loan, I get this maybe once a week, especially when everybody was, borrowing money a few months ago. It was like 3 times a week I was writing these letters. And what the bank wants to know, and they want CPA to actually put that in writing, is to say, if the owner were to take the cash out of their business, do you think their business is still going to be okay? So are you going to jeopardize this business by taking money out to put as a down payment on the property? Which it's a really hard thing for CPA to say, because I have no idea. It depends how much money they're taking out and what else is going on with their business. But we just roll our eyes and talk to the bank, and but that's exactly it. It's, can I take this money out, retain the cash that the business needs for its operating needs, however much we decide that is, to cover our expenses, to make sure we can cover payroll, and everything else is really available for the owner to take. So that is definitely what everybody wants to know at the end of the day.
Yeah, definitely. I have seen income statements where they group those owner benefits at a separate section down below the operating expenses and things like that, so that it's easier to pull it out. And if you've been doing that for several years, it's easier to show the value of your company when you go to sell it. And I'm a big fan that you should run your business as if it were going to be sold, even when you're not thinking about selling it, because you, as somebody said, you are going to exit your business, whether it's your choice or somebody else's choice, or you know, go feet first.
Oh, absolutely. Absolutely. In fact, I was talking to a client just a few weeks ago, and they're starting to think about possibly selling their business in, let's say, 3 to 5 years. So their question to me was, what do we have to do now in terms of how to set up our record keeping system, our, you know, paperwork, and to make sure that when the potential buyer comes, we are clean. You know, if they look under the hood, they see all the documents. So of course, there's some legal stuff to do. And we talked exactly about that, John, is to set up your financials in a manner that if the potential buyers pulling them out, it's easy for them to see which expenses are which, to create that category that is for the owner expense, which I told them, please don't worry, I will still deduct them on your tax return while you own the business. But it'll be easy to pull that out and even show that to the new prospective owner, but also to create some history there, because if you're planning on selling your business, let's say in the next year, usually people are looking at the last 3 to 5 years of financial statements. So they want to be able to pull those financials and see comparative trends and see that cash flow. How was the cash flow in the last 3 to 5 years, not just how was it, you know, this past year. So I think that these are definitely important things that the owners need to be looking at.
Yeah, well, congratulations to get your client to think 5 years ahead of time.
Exactly.
Start planning for this.
Exactly.
You know, what I do with the piece that I contribute to clients, and it does have to be 3 to 5 years ahead of time, is not about the financials, but how to get their business organized and systemized so that it doesn't depend on them on a day-to-day basis. So that when somebody does buy it, first of all, that the work that they do in the business is properly accounted for, and that's where you would use the CPA, but also the delegation, the systems, the information, the relationships that live in the business owners' heads, those are dispersed throughout the organization so that when they leave, the business keeps going exactly as it was.
Yep,
so,
absolutely.
So these are the numbers that we have been talking about today. I want to leave you with two main takeaways. So from our little Chinese restaurant here, the first one is how important gross margin is. It's important in its own right. It also plays into several of the other of these numbers that we looked at today. And the second piece is every time you spend money, you should know why you spent it. What are you hoping to accomplish? And generally, the categories that you spend money on are to make something that people want to buy, to find those people and sell to them, to support the making and the selling, that's the overhead, or to grow. And so that's the reason that you spend money in a company, but you should know in specifics why you're spending each dollar. So if you would like a copy of this slide deck, you can email me, john@ceobootcamp.com. I know Marina is going to put the video of this up on her website. She can tell you all about that. So thank you very much.
Thank you so much, John. This is wonderful. Yes, this webinar is going to be recorded. It's going to be distributed and posted on our website, koontzandparkin.com and koontzandassociates.com. Also on our YouTube channel, so you can search for that and see all of our past webinars. So there's some fantastic and interesting information there. Next week, we will be bringing you some year-end tax planning ideas. So that should be an interesting webinar. So please tune into that next Tuesday. John, thank you so much once again. Thank you everybody for attending, and we will see you next Tuesday. Thank you.